In March 2023, the financial world was shaken by the sudden collapse of Silicon Valley Bank, SVB, a pivotal institution deeply embedded in the technology sector. This event not only disrupted the operations of numerous startups and venture capital firms, but also prompted a reevaluation of banking practices and regulatory frameworks. In this comprehensive analysis, we will explore the history of SVB, the factors leading to its downfall, the repercussions on the tech industry, the responses from various stakeholders, and the lessons that can be drawn to prevent future occurrences. Established in 1983 in San Jose, California, Silicon Valley Bank was designed to cater specifically to the burgeoning technology industry. Recognizing that traditional banks were often hesitant to engage with startups lacking substantial assets or revenue, SVB positioned itself as a financial partner, willing to understand and accommodate the unique needs of tech entrepreneurs. Over the years, SVB became the preferred banking institution for nearly half of all venture-backed tech startups, offering a range of services from basic banking to complex financing solutions. SVB's intimate involvement with the tech ecosystem allowed it to grow alongside its clients. The bank not only provided capital but also invested in venture capital firms through its fund of funds, granting it valuable insights into emerging trends and companies. This symbiotic relationship fostered an environment where SVB was more than just a bank. It was a cornerstone of the tech community. The downfall of SVB can be attributed to a confluence of internal missteps and external economic pressures. Internally, the bank's risk management practices came under scrutiny. Regulators had previously warned SVB about its risk management practices, sending cautionary letters that preceded more severe actions. The New Yorker externally, the economic landscape played a significant role. As the Federal Reserve increased interest rates to combat inflation, the value of long-term bonds decreased. SVB's significant exposure to these assets meant that its portfolio suffered substantial unrealized losses. Simultaneously, the tech industry experienced a slowdown, leading to decreased deposits and increased withdrawals from clients who were themselves facing financial challenges. This dual pressure created a liquidity crisis for the bank. If you're enjoying this breakdown, make sure to hit that subscribe button and turn on notifications. We've got a brand new history series in the works, and we want you to help shape it. Be on the lookout for our upcoming community poll. Your vote decides what we dive into next. The immediate impact of SVB's collapse was profound. Startups and tech companies that relied on SVB for day-to-day banking found themselves unable to access their funds, jeopardizing operations, payroll, and vendor payments. The bank's closure disrupted the financial services that many tech companies depended upon, leading to operational challenges across the sector. Beyond the immediate operational disruptions, the collapse had broader implications for the tech industry's financial landscape. SVB was a significant provider of venture debt to pre-profitable, venture-backed companies at reasonable rates. Its absence left a void in the financing options available to startups, potentially making it more challenging for them to secure funding. The collapse of SVB prompted swift action from regulators and policymakers. Federal regulators announced that all depositors of Silicon Valley Bank would be able to access all of their money, aiming to stabilize the situation and restore confidence in the banking system. The Federal Reserve also took steps to address the crisis, including measures to provide liquidity to other banks and prevent a potential domino effect in the financial sector. Brookings industry leaders and entrepreneurs expressed a mix of relief and concern. While the government's intervention ensured that immediate financial losses were mitigated, there was apprehension about the long-term implications for the tech ecosystem and the availability of specialized banking services tailored to the needs of startups. The collapse of Silicon Valley Bank underscores several critical lessons for the banking sector, regulators, and the tech industry. SVB's failure highlighted the dangers of inadequate risk management, especially for banks with concentrated exposure to specific sectors. Ensuring that risk assessment models are comprehensive and account for various economic scenarios is crucial. The incident revealed gaps in regulatory oversight, where warnings were issued but not acted upon decisively. Enhancing the effectiveness of regulatory frameworks and ensuring timely interventions can prevent similar failures in the future. For startups and tech companies, the collapse served as a reminder of the risks associated with relying heavily on a single financial institution. Diversifying banking relationships can mitigate potential disruptions. The event has prompted discussions about the adequacy of existing banking regulations, particularly concerning capital requirements and the oversight of banks that, while not among the largest, play critical roles in specific industries. In conclusion, the collapse of Silicon Valley Bank serves as a poignant reminder of the intricate interplay between financial institutions and the sectors they serve. It underscores the necessity for vigilant risk management, proactive regulatory oversight, and the continuous adaptation of financial practices to the evolving economic landscape. As the tech industry and banking sector move forward, the lessons drawn from this incident will undoubtedly shape future strategies and policies to foster a more resilient financial ecosystem.